All right, so let's start walking through our example transactions here. We're going to start actually writing out these journal entries. This is what we are doing. We're journalizing now, right? So we're going to start these journal entries. So on December 1st, and these are just the transactions that we talked about earlier on in this chapter, right? Where we decided, did we pay cash? Did we increase this account? Did we decrease this account? Does the accounting equation still balance? These are the same transactions. So this one I think I got, yep, sorry. Let's start here on the actual December 1st. On December 1st, we issued or sold shares of common stock for $1 million to obtain the funds necessary to start the business. So we've got common stock. Common stock is an equity account. Equity is a normal credit balance, so we're going to increase it with a credit. Again, one other way to look at this is, it exists, it lives on the right-hand side of the equation, so we're going to increase it with something on the right, meaning a credit, because credit equals right. Or we could look at this as, is it in our DEAD acronym? Is it in, where is it on our dealer acronym? Is it an expense, an asset, or a dividend? No, then it increases with a credit. So you've got common stock. Okay. We're going to increase that by $1 million. Well, what else have we done? Well, we got cash for that. And that's an asset, which falls on the left-hand side of the equation. So we're going to increase it with a debit. Assets increase with debits. So we're going to do that. Okay. So if you wanted to, we could start filling out our T accounts here. And we could say, okay, journal entry number 1, right? We had $1 million debit. And we had $1 million credit. You can see where those all line up, right? Perfect. So let's move on to the second one right here. And look, we borrowed $500,000 from a local bank. We signed a note, so a note payable. That's a payable. So we know it's a liability. I know we talked about this already, but it's okay to reiterate that so we understand what we're looking at. So we are going to start with our debit. What did we increase? Well, we increased cash, right? We got cash from the bank in the amount of $1 million. Okay, so that is where we're going to start. Or excuse me, $500,000. Don't listen too closely. $500,000 right here. So we've got a debit, and we know that our debits must equal our credits, right? I've said that a couple of times. So we know now we need a credit. Well, what do we credit? We credit that note payable, that liability account, that account that tells us, hey man, you got to pay them some cash in the future. How much cash? $500,000 in cash is what we're going to owe them in the future. So we got journal entry 1 here. We got journal entry 2 for $500,000. That's going to be a debit to cash. And we've got a $500,000 credit to the notes payable T account. Okay. Now transaction 3. All right, we're going to purchase equipment for $240,000. Purchase, no other condition, meaning it didn't say on account or anything like that. So we know this is cash for $240,000. And it told us it's equipment, so we know the asset. Okay, so what are we gonna debit? Well, we need to increase an asset, and that asset is equipment, right? We're going to increase it by $240,000. What else happened? Well, we gave away $240,000 in cash. That's our credit. We are decreasing cash here. Right? That's a decrease to an asset of $240,000. Okay? So what have we done here? Well, we are going to credit cash for $240,000 because that's reducing it. We're going to, sorry, I got ahead of myself, but same concept here. Let's get this back in here. So we're going to credit cash for $240,000, for $240,000 because it's a decrease. And we're going to increase equipment for $240,000. Now this again is what we call a net zero impact, right? Because we increased an asset by $240,000 and we decreased an asset by $240,000 equaling to 0. Okay. So transaction 4, we paid 1 year of rent in advance for retail and warehouse space of $180,000. Again, it tells us we paid, so that tells me cash. Okay. in advance, so this means it's prepaid. So now we've created an asset for ourselves, and it was $180,000. So we know our debit and our credit both are going to be $180,000, right? Because they have to balance, they have to equal. But what are our debits and what are our credits? Well, we have created a new asset for ourselves, a new resource called prepaid rent, right? That's going to be our debit because that's an increase to an asset. But we gave cash away, so we're going to decrease cash with a credit. That's a decrease to an asset. That's a credit, okay? So we're going to go here, number 4, and that's going to be that $180,000, okay? Prepaid rent, we're going to debit for $180,000, right? So hopefully you guys are starting to follow along, start to understand this. So transaction number 5, okay? Transaction number 5, we purchased supplies on account at $14,000. So we purchased, but it's on account. So on account tells me this is a payable. And a payable tells me what? Well, that it's a liability, right? So liabilities we know are credits. So we know our credit is going to be accounts payable. What's our debit? Well, we got supplies. That's our new asset. So we're going to debit supplies for $14,000. That's an increase to an asset, right? Okay. So let's go ahead and write that down here. Debit supplies, $14,000. It's an asset. Accounts payable, well, I shorten that to AP, but it's accounts payable, $14,000. Okay. So we will write that here. Transaction 5, $14,000 on the credit side. Now again, these are just T accounts, right? We're following the flow. You'll see all these put together as T accounts, and you'll be able to follow what has happened, okay? And you'll see that it makes coming up with ending balances to put on trial balances much, much, much easier to do. So let's move on to transaction 6. Transaction 6, we purchased 15 robotics units as inventory for $750,000. Total sales purchased. This means cash. This is an asset. And again, inventory is an asset, right? So that's the amount, $750,000. So we know we've got a debit of $750,000. We know we've got a credit of $750,000. Which asset increased? Which asset decreased? Well, inventory increased, and we increased assets with debits. Cash decreased, so that's going to be our credit because we decrease assets with a credit. Okay, so again, here we are right back to cash. Transaction number 6, $750,000. And then inventory, we increased by $750,000. Okay. Transaction 7, we're going to record revenue from the sale. What did we sell? Well, we sold $70,000 worth of robots for cash. Okay, so that's an asset that increases. And we sold on account $280,000 worth of robots. On account tells me it's accounts receivable, which is an asset. So we know we've got 2 increasing assets, which are going to be debits. Okay. What else are we going to increase? Well, it tells us right here, revenue. Where does revenue live on the accounting equation? It lives on the right-hand side. So we're going to increase that with a credit. Okay. Also, it's not part of your DEAD acronym, right? It's not an expense, an asset, or a dividend. So it's going to increase with a credit. So let's go ahead and write those down. I typically start with the larger number first. So I would start with accounts receivable. Okay, $280,000. Then I would say cash, $70,000. So what should our credit be? Well, it should be the sum total of these two, $350,000. That is going to be service revenue, okay, or sales revenue, probably. Yeah, we sold it, so it's going to be sales revenue. Okay, so what do we do here? Well, now we've got a couple of different accounts that we're going to use, 3 to be precise. Well, we got cash, so we're going to say this is transaction 7. We got $70,000 in cash. We also got receivables in the amount of $280,000. Okay, and then we've got our sales revenue, which was a credit of $350,000. Okay, So continuing part 7, we now have to recognize that expense because in accounting, particularly accrual accounting, we match our expenses to the revenues that they help generate. And since these expenses, what it cost us to sell these items, helped us generate this $350,000 in revenue, we have to recognize it in this period. How are we going to do that? We're going to record the cost of inventory. We're going to call this probably cost of goods sold, right? Cost of goods sold. That's an expense. It is an expense, okay? What happens with expenses? They increase on the debit side, right? How do we know how much to charge for this? Well, we have to look back at some other accounts, right? We'll start at transaction number 6. Sorry, look at other transactions. We paid $50,000 per unit. That was our cost per unit. How many did we sell? We sold 5. So we would simply take that 5 times 50,000. That's going to give us $250,000. Okay, that's going to be our cost of goods sold. That $250,000 is what it cost us to make that $350,000 in revenue. Okay, this is just an expense. And typically, I told you guys, retailers' cost of goods sold is going to be their largest expense. Now we've just got to figure out what account are we decreasing. Okay, what account do we have to credit here? Well, it's going to be inventory, right? We sold the inventory. We no longer have that inventory. So that inventory has to decrease. And it is going to decrease by the amount that we paid for it. So that $250,000, the same as the cost of goods sold. So here we're going to increase our cost of goods sold by $250,000. We're going to decrease our inventory by the same amount, $250,000. Okay. Transaction number 8. Okay. On December 23rd, we received cash in advance from customers for customization services to be performed in the future, $100,000. So we know the amount. We know we've got $100,000. We know that our debits have to equal our credits. So we know that our debit's $100,000 and our credit is also $100,000. Now we just need to ask ourselves, what are the accounts that are impacted? What were the accounts that were affected? Well, we received cash. So that's an easy one. That's an asset, right? Assets increase with a debit. So let's say cash, $100,000 increase. Well, what are we crediting? Well, typically we'd want to credit revenue, right? Because we've sold something. However, in this case, please note that we got this cash in advance. We're going to provide these services in the future, okay? This is that unearned revenue. Okay, this is a liability. Liabilities, right-hand side of the equation, they're not an expense, they're not an asset, they're not a dividend. They're going to increase with a credit. Okay, so here we go. Cash, transaction number 8, $100,000. Deferred revenue, unearned revenue, whatever you want to name it, credit it for $100,000. Okay. 2 more to go. I know this is a long one, but I want to get through all of these with you guys. So, transaction 9. Let's make sure this is looking better here. Sorry. There we go. All right. So, transaction 9. On December 28th, we're going to pay employees salaries of $28,000 for the month of December. Okay. So, what have we done here? Well, we've paid. So, that tells me, again, cash. Okay. And then salaries, well, that's an expense. Doesn't tell us we're paying salaries that we owed or anything like that. This is just we're paying salaries. So we know, again, our amount is $28,000. That's easy. We can just write those down. We know our debits have to equal our credits, right? But what are we debiting? What are we crediting? Well, an expense is part of our debt, right? It's the expense. It's the E in our debt acronym. It's the E in our dealer acronym, okay? So we'll say salaries expense. Okay, $28,000. What are we crediting? Well, cash, right? That's an asset. We're decreasing cash, so we're going to credit it. Cash, $28,000. So here we go. Transaction 9 in your T account for cash is going to be $28,000 on the credit side. For your salaries expense, it's going to be $28,000 on the debit side. Okay. Transaction 10, our final transaction here. Okay. We have that on December 30th, we paid cash. It just tells us straight up we paid cash. Again, that makes us happy because cash is easy. But we paid it in dividends, $14,000 to shareholders. Okay. Dividends, again, is part of your acronym, right? It is the D. It is that second D in DED. Expenses, assets, and dividends get increased with debits. So, dividends by $14,000. What's the other one? Cash. Right there, cash. What did we do? We decreased it. Cash is an asset. We're decreasing it. We're going to credit that for the same amount of money, $14,000. So let's write these down in our T accounts. $14,000 to cash on the credit side. This is going to be a decrease in cash. $14,000 on the debit side of dividends, an increase to dividends of $14,000. Okay. So here are all the journal entries that we've made and what they look like. Okay. You can see here, cash was an increase to an asset. Common stock was an increase to stockholders' equity. Cash, increased asset. Notes payable, increased liability. Equipment, increase to an asset. Cash, decrease to a liability. So on and so forth. This exhibit is in your book if you want to look at it in more detail. And then finally, we're going to have a look here at our T accounts that we created. And these are all going to be the ending balances in our T accounts, right? Our ending balance for cash was $458,000. Ending balance for accounts receivable, $280,000. Ending accounts, or ending in liabilities, $14,000. And then once you add all of these up, all of our assets, all of our liabilities, all of our equity, our A equals L plus E, still true. Okay, that is going to hold true throughout the entire accounting cycle. Okay, so any questions about these journal entries, please contact me and let me know. I'm happy to answer any questions for you.